Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 22nd of May, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few of my market observations. One is oil price is relatively unchanged. Leadership change in Iran has not spooked the market. This is good overall. Our inflation in services is keeping the CPI high. Generally, companies are performing well. I expect the ASX 200 to break 8,000 this year. I'm not sure when, but I do expect it to get there at some point. RBA outlook remains highly uncertain. Well, at least they're being honest. RBA revised CPI forecast. This is significant. The orange yellowish line is what it used to be, and now the dark line is what they've revised it to. So basically what they're saying here is that they're going to keep rates higher longer because the CPI is staying higher longer. But if you go out to 2025, there's a convergence. So they expect that once the CPI starts coming down, it'll start coming down faster. Well, we know what happens with forecasts. I wouldn't bet the farm on this actually happening. Magnificent Seven in the US are remaining very strong. The white line is their performance. The blue line is the S&P 500 performance, excluding the Magnificent Seven. If you just buy the 7 stocks that make up the Magnificent Seven, you'd be significantly outperforming the S&P 500. However, it's never that easy. Murphy's Law says the second you buy, that's when they top out and they're going to plummet. Now, when you have a company that goes up so dramatically for so long, so quickly like this, when it turns, it can get ugly real quick. So it's good being on this train for now, but if you get on, make sure you know when to get off quickly. Here's another chart of interest. Australia, total trade by country. Look at China. It dwarfs everybody else. This is actually pretty dangerous for us as a nation. We can't be as reliant on China as this is showing. China will have undue influence over our policies. We do have to take this into account. Ticket sales for live comedy. Now this is in the US, but it applies here, I'm sure. This is just fascinating. If you look this year, suddenly live comedy is getting very popular. That dark green line is dramatically outperforming all previous years. To me, I love live comedy, so I think this is very encouraging. Going to live comedy is very fun. It is clean. It's a great night out. Copper price per metric ton. Well, the reason I showed this is because copper's on a roll. It just keeps going up and up. What this does show is that it's been high before, but now it's at like record prices. Will it continue going up? Well, that's a hard question to answer. There's a lot of fundamentals that say there's a supply shortfall. The demand is going to soar because of the need for electric cables, electric wiring and motors, you name it, and that the supply is not going to come on board fast enough. We do know historically supply will get there, but there's a lag, which means copper prices can go higher. Now, these are copper inventories. The significance here is that on the right side, you see inventories are dropping. These are as reported by the various exchanges like the LME. As inventories decline, that is a bullish signal that there's not enough supply to meet future demand. This is another reason why copper prices are going up. A third thing about copper right now that I find absolutely fascinating is that the price difference between where it's trading in Chicago, which is near $5 a pound, and London, which had been around $4.60 a pound. Well, in this day and age of high-speed communications, trading, technology, etc., this arbitrage, you wouldn't expect huge price difference like that. But it's there. It's now closing. However, it is not that Chicago is going down, it is that London is going up. So the price is getting close to merging, which is what it should, at around $4.90 a pound, at least for now. You know, the future price can be anywhere. This slide is fascinating because this shows budget airlines and where they make money. You would think it's from the airfares. Wrong. It's in all the fees. The fees are amazing, from luggage to being late to whatever. Now, the U.S. Congress is addressing these fees, saying that when you buy your ticket beforehand, everything has to be disclosed. No hidden fees that you get hit with after the fact. So this chart is a little out of date, but it does show why governments around the world are looking into this matter and trying to fix it. Budget airlines make more money on all the extra fees than they do on the fares themselves. James Hardie. Now, this is a company I've been following a long time, and I like it. I've been bullish on it. And I only have this one chart for one reason. They announced their earnings. It wasn't that great. However, it wasn't that big of a disaster. The stock dropped $10. You can see on the far right how it dropped. Now, it's trading up again today. It's up like about 90 cents. But what this is showing us is that in the United States, when there's an earnings surprise on the upside or a negative surprise on the downside, the companies there move huge amounts, like 10, 20%. We don't normally see this here. James Hardie, we saw it. Is it alarming? No, if you're comfortable with James Hardie fundamentals, which I happen to be, it's actually a buying opportunity. But you do have to have a lot of fortitude to really continue buying in the face of one negative earnings report, which isn't all that bad. Aristocrat Leisure. I covered this last week, and I was neutral on it. I gave all the reasons for it, but I also said they were reporting Thursday morning, and it's worth taking a look. Well, they came out with an excellent report. Every analyst likes them now. This is what we have with Aristocrat Leisure. On a revisit from last week, with a market cap of $26 billion, the price target last week by 5 major brokers was $44.42. Today, it's $50. That is a huge jump in price targets. Revenue growth for the 2023 period to 26 period jumped from 4% to 6%. That's not significant, but the earnings per share growth in this period went from 5% to 13.5%. And the dividend growth increased also. Obviously, when you have this change in the fundamentals, the price gets re-weighted. It was trading near $40 at the time last week. Now it's around $47. It was a very quick recalibration. The PE on now, the 2025 earnings per share estimate of $2.68 is 17.5 times. Well, that's because the estimate has been raised. Last week, the PE was around 17 on a lower earnings estimate. So with the stock trading at around 47, it quickly adjusted to the current world of where a 17 PE price should be, and that is around 47. However, with those strong fundamentals, don't be surprised if it continues going further up, because after all, look at what all the brokers' price targets are. Now, the yield on the new 2025 dividend estimate of 86 cents is down a little bit, 1.8%, but you don't buy Aristocrat for the yield. Free cash flow is 5.5%, and the payout, I had 50% last week. That was what UBS was thinking further out, because they were going to be increasing their dividend to entice shareholders to remain in the company. But now they don't need to increase the payout because the forward estimates are strong enough to keep the stock up. So they're keeping the payout at around 32%. The strong earnings report caused all analysts to re-rate their forward earnings estimates. Price jumped to the now higher EPS, but leaving the PE the same as said. Accordingly, I like Aristocrat. I don't love it, so I buy it with a half weight. Second company today I wanted to cover is GrainCorp. The code on the ASX is GNC. It's trading now at $8.44. This came across my desk and I wanted to drill into it a little bit, and I figured I'd share that with you today. I happen to like agricultural companies. They are heavily dependent upon rain. Now, looking at this 5-year chart, we see that it's pretty volatile. It spiked up, came down, and now it's trending back up. So it is the more recent trending back up, which is significant here. Looking at the numbers, one, it has a market cap of $1.9 billion. These are Macquarie estimates, by the way. 12-month price target by Macquarie is $9.24. The revenue growth from 2024 to 2026 is negative 1.7%. Now, I'm not using 2023 because those are huge numbers. They had an amazing, extraordinarily good year. That is not a fair base to use. So I'm looking at 24 as the base and how it is going forward. The EPS growth in 2024 to 2026 is 23% per annum. So that's excellent. But the dividend growth in this period is negative 7%. So that's a concern. Because I couldn't really get a picture using these three growth rates, I wanted to look at EBIT growth from this period, and that's positive 13%. So that's a significant item. If you can't really find something conclusive with the standard ratios, look at something else that's a valuable ratio, and that's earnings before interest and tax. The PE on the 2025 earnings estimate of 37 cents is 23 times. The yield on the dividend estimate for that year is 34 cents or 4%. The free cash flow is 7.5%. Payout ratio is 70%. So what is GrainCorp? They don't grow grain, they don't grow malt, they don't grow wheat, whatever. It's a grain storage, handling and freight services company, as well as being the dominant competitor in bulk exports for grain terminals. Because of all the uncertainty here, and it's not really clear how they're going, and it's dependent upon so many issues they have no control over, I rated a neutral. Last company is Telstra. I threw this in this morning because yesterday Telstra announced that they're firing 2,800 people. They're trying to save $350 million. Well, I figured, one, when you're laying off that many people, is that bad for the company? Are they doing it because they're performing poorly and they need extra cash flow? What is the real reason? Well, with what Telstra was saying, I'm still not totally clear because they need to reinvest into various growth opportunities. I'm not necessarily sure, but I wanted to look at the numbers today from brokers. And I picked up a report from UBS, and this is what they're saying. One, Telstra is a huge company with a market cap of $41 billion. They have a price target of $4.40, and it's currently trading at $3.57. That is a massive price target. Is it realistic? Well, in my view, Telstra doesn't have huge growth rates to justify that. I've never seen Telstra share price jump from $3.60 up to $4.40. I mean, that's a 25% increase. That's massive. Revenue growth the EBS has from 2023 to 26 is at 2% per annum. Well, they aren't really growing their business, are they? That's below inflation rate. Earnings per share growth, well, that's 9% per annum. That's decent. And dividend growth is 8% per annum. Now let's take a look at, is the share price reasonable based upon the PE on 2025 earnings estimate of 18 cents? Well, that calculates at 20 times. For a slow growth company, 20 is a little bit on the high side. The yield on the 2025 dividend estimate of 19 cents is around 5.3%. So that's okay. Free cash flow, 7%. That's good. Payout ratio, well, it's over 100%. I don't trust companies paying out more in dividend than they're actually earning in profits. Analysts are expecting an improvement by 2026, and this is why they're jumping up the price target. We're in 2024. We got 2025, then 2026. I don't know. That's a long ways away. A lot can happen between now and then. As a consequence, I'm neutral in Telstra. Basically, I would avoid it. There's many other companies that are better. As always, if you want me to go into any more detail on anything covered today, send an email to stockwatch@fnn.com.au and direct your question to me, Chris Pedersen. Have a wonderful and profitable week. Thank you for your time.